Unfortunately, the person who leads the largest bank in the United States still sees a recession ahead despite the 90-day pause on tariffs that we got recently. So let's jump in and see what's going on, because if there is a recession ahead, there's things we all need to do. So first, I'm going to share with you what Jamie Dimon, the CEO of JP Morgan Chase, had to say, and then I'll share my thoughts on how we can protect ourselves. Okay, we're going to start off with the Economic Times, and the article is titled, "Think the Worst is Over for the Markets. JP Morgan's Jamie Dimon still sees a U.S. recession ahead despite Trump's 90-day tariff pause." And they go on to say, on Wednesday, the financial giant reaffirmed its 60% probability call, even after Donald Trump announced a temporary halt to most of his sweeping reciprocal tariffs. And Jamie Dimon, who's the chief executive at JP Morgan, was speaking to Fox News, and he said a recession is a likely outcome. And he was pointing to a fragile consumer confidence, surging bond yields, and a flurry of retaliatory tariffs from China. Jamie goes on to say, "I hear it from just about everybody now. I'm going to cut back just a little bit. I'm going to wait and see what happens," he told Maria Bartiromi. That is kind of recessionary talk. Okay, Dimon warned that defaults could follow if you have rates going up just a little bit and inflation is sticky and credit spreads are gapping out, which they're going to do. I think you see more credit problems than people have seen in a long time. And what he means by credit problems is companies defaulting on the debt that they've borrowed, and that can have a ripple effect. Okay, let's move on to CNBC. Their article is called "Jamie Dimon Says a Recession is Likely Outcome from Trump's Tariff Turmoil." And I want to share this because he says something I think is very insightful and important for all of us. He admits that markets aren't always right, but sometimes they are right, Dimon said. "I think this time they are right because they're just pricing uncertainty at the macro level and uncertainty at the micro level and at the actual company level. And that is how it affects consumer sentiment. And then how it affects consumer sentiment after that is hard to tell." But importantly, he says, "I'm taking a calm view, but I think it could get worse if we don't make some progress here." And by progress, he means on getting these these trade agreements renegotiated. Okay, one last thing by Reuters, and I'll jump into how do we all protect ourselves. Okay, Reuters says JP Morgan CEO Dimon expects recession and defaults, and he urges quick trade talks in an interview with Fox Business News. Dimon, who's 69 years old, is one of the most prominent voices in corporate America, and he's regularly been consulted by administrations during time of crisis. So I wanted to share that just so you have an idea of who Jamie is. He's one of my favorite CEOs. I think he does a great job. He says, Jamie Dimon says, "The bad part of these volatile markets is what it does to the capital markets and the ability of companies to raise money. So IPOs are being canceled, a couple hung deals out there in high yield land, bridge loans, and that just slows everything down. And when companies get slowed down, they get more conservative, they make fewer investments, and they're tempted to lay off people in times of uncertainty." And again, that can have a ripple effect in an economy like the United States, where almost 70% of our economy is based on people spending money, is based on consumer spending. And when people get laid off, obviously they spend less money. I want to wrap up the articles with just one last thing, and then I'll share my views. Let's go back to the Economic Times. And Jamie Dimon says, if there is a recession, hopefully it will be short. And that's how I feel, right? Just because there's a recession doesn't mean, it doesn't mean all is lost. In fact, recessions are a normal part of an economic cycle. And just like trees don't grow to the moon, right? You might have a tree in your backyard that's grown 6 foot over the last 6, 10, 15 years. It doesn't mean it's going to keep doing that. At some point it pauses. And it's the same thing with the market. We grow for a period of time, Then there's a time of digesting it, and unfortunately slower growth and sometimes negative growth, which is what a recession is. So times can get difficult, but the important thing is it doesn't have to derail us, right? If over a 20, 30, 40-year career, it's likely we're going to weather 3, 4, or maybe more recessions. So how do we weather these recessions? Well, the first thing is giving up the fantasy that we can time the market. We cannot time the market. Multiple studies have been shown that it's time in the market that leads to long-term success. It's not trying to time the market. The challenge is if we try to time the market, we're likely going to be out of the market on its biggest days, and we're likely going to be on the sidelines for too long. And multiple studies have shown that we just can't do it. We're much more likely to underperform than we are to outperform. And the longer we stay out of the market, the more likely it is that we're going to underperform. So what do we do instead? What we do instead, number one, is we make sure that our own house is in order. And what I mean by that is it's boring, but it's super important. And that is having an emergency fund. 3-6 months of living expenses, maybe more, so that if, God forbid, we do lose our job, we have the time to find the right next job for us, and we're not under that intense pressure at a time where we need to be at our best in order to find another job, in order to keep our family from panicking as well. So having that emergency fund, yes, it's not fun having it in the bank where we're getting very little, if any, interest, but that's not the purpose of it. The purpose of our emergency fund is not growth. The purpose of it is to help us weather the storm. So that's number one. And then number two, we talked about have that long-term asset allocation where we don't have to time the market. We're not thinking extremes. Most of us are much better off with a long-term allocation that we stick with in good times and bad times, as opposed to saying, I'm going to increase my equities in good times and decrease it in bad times. Boy, it'd be great if you can do that, but unfortunately, none of us can do that. So have that emergency fund, have that long-term allocation. And then the other thing is have somebody along your side, preferably a professional, to help you make good decisions along the way. And that's really what a financial advisor does. To me, that's the gold standard. And yes, financial advisors are not inexpensive. Most financial advisors charge about 1% a year. But think about the cost of making one 10% mistake. Now, the reality is most of us are not going to use a financial advisor. Most of my audience would prefer to do it themselves, either because they can't find somebody that they trust or they can't justify the cost. If you are going to do it yourself, I urge you to use software designed to help you develop your own financial plan and make sure that there's no formula mistakes. Make sure you're thinking about the right things. It's just too easy to make a mistake if you're using Google Sheets or Excel. The software I like is called Bolden. It used to be New Retirement. You can find it in the description below. And if you like this video and videos like it where I talk about making good decisions, the YouTube algorithm says this is my next video that you should watch. Thanks for watching this one. Bye-bye.